Today's market movements and more. Marcus Bogdan from Blackmore Capital joining us live from Melbourne. Marcus, great to talk to you. All right, so the beginning of a new financial year. How would you assess whether the local market has been over the past 3 to 6 months?
Good morning, Andrew. Well, we've had an incredible recovery in the share market over the last year, but I think that's been justified by the very strong economic growth that we've seen, and that has translated into extraordinarily strong earnings growth. And if we look forward, the expectation is for this upcoming reporting season for FY21, earnings growth of plus 25%, which is reflective of around the 23-24% recovery we've had in the ASX 200. So in that sense, I think we can take comfort as investors that it has been fundamentally driven.
Okay, so how are you approaching your investment strategy at the moment? I guess there's a little confusion there, given, of course, we've got more lockdowns in Australia at this point. Question marks whether that reflation trade is over. So how are you balancing? You're taking it from a barbell approach.
Yeah, there is absolutely a lot to navigate, and we're seeing a lot of cross currents. It's particularly in the last month or so, between value, growth, and defensives. And I think probably expand on the barbell. It's really a three-pronged approach in terms of the way that we think about portfolio construction today. In the first instance, we are wanting to be weighted to those companies that are driving these earnings upgrades, and that is in companies in the banking sector, in the resource sector, and also in a very specific area in healthcare in the pathology providers. The second area, I think, where warrants are holding in is those companies, those consumer staple companies that have just delivered very consistent growth throughout COVID and whenever we do have these lockdowns. Woolworths, Wesfarmers, and now we've got Endeavour, which we've just recently increased. And the third element is that ultimately we're seeing this recovery, and ultimately we will reopen, hopefully on a more permanent basis. And so we do want to be exposed to those reopening plays, and what we've talked about before, these quality laggards, which haven't participated in such sharp movements in the overall share market.
All right, let's just pick up with Woolies there, which we have on screen, of course, having demerged Endeavour. So you're happy to hold both at this point?
I am. I think Woolworths is one of those companies which will come out of this pandemic in a stronger, more competitive position, particularly in what they've done online, and I think that'll be a permanent change, and they'll be a beneficiary of that, and that warrants the premium price that they have today. And then secondly, the spin out of Endeavour, and we have added to that position in the last couple of days. See, very strong cash generative business, both in the retail liquor and the recovery in hotels. And so those two companies are core in the portfolio.
All right. Let's move to healthcare. You mentioned that. Specifically, where are you looking for that opportunity?
Well, this is where there is a barbell approach. The beneficiaries have been in pathology. And so if you look at PCR testing, the COVID testing that we're seeing now, those numbers are up over 200% compared to the daily averages in March, and that will drive very good earnings upgrades for both Australian Clinical Labs, Helios and Sonic. And then those are the ones which have been affected by the pandemic, companies like CSL and Ramsay, that have materially underperformed the benchmark over the last year. And in essence, they've given sort of a flat return compared to a 23-24% improvement in the overall index. But we do think that both CSL and Ramsay are very strong businesses, global leaders in what they're doing, and they will recover.
All right, more broadly in that space, CSL, of course, the big one there. How are you looking at that stock at the moment where the company's placed?
Well, it's been incredibly sensitive and volatile around the foot traffic that they're seeing in their US collection centres. And in about a month ago, you did see very consistent improvements there in foot traffic as the population in the US has been vaccinated. But then in recent days, we have seen a scare there on the US-Mexican border where they've stopped Mexican donors crossing the border to donate plasma. Now, this may be a short-term outcome, but it is also not material in terms of CSL's overall business in the US. So, for example, in the US, there are around 270 collection centres across the nation, and it's only around 4 or 5 centres that are affected on those border towns. So that's been sensitive, but we do think that the underlying demand for plasma is around 10% per annum, and we expect that to continue. And then the second element to CSL is obviously they have been a beneficiary of vaccine, particularly in flu, and I think that the Northern Hemisphere flu season will be particularly strong again in the US.
All right, and you did mention the financials there. Obviously, they've done well of late. What's your outlook?
So if we look at the data that we saw yesterday on credit growth, that is accelerating. You're seeing a very good, strong demand in owner-occupied lending, growing at around 7%. Given the strength in the housing market, we do want to be weighted to the mortgage banks. Those are CBA and Westpac. Both of those are seeing at system or above system growth there, generating 4 to 5% dividend yields and a very strong recovery in earnings.
Marcus, very comprehensive. Thanks for joining us from Blackmore.
Thank you very much, Andrew.